Gap just reported after the close, and right now it sure looks like they're in the latter group. Not only did Gap deliver a big top and bottom line miss, management also cut their full-year forecast substantially. They talked about an inventory shortage caused by port congestion and COVID-induced factory closures in Vietnam, a big supply base for them, not to mention rising shipping and labor costs. All told, they said supply chain crisis could cost them up to $650 million in lost sales, while also eating into their margins as we head into the holidays. And that's why the stock's plunging after our trading. Now, Gap shares have come down big from its highs, but this story just became a lot more difficult. Can they turn things around? Are they doing better now? Let's dig deeper with Sonia Syngal. She's the CEO of Gap. Find more about the quarter and where our company's headed. Ms. Syngal, welcome back to Mad Money.
Hi, Jim. Good to see you again.
Thank you so much for coming on the show. Okay, I do want to make sense of this because, first of all, I think that you're trying to build enduring customer loyalty. That's your point. But it's going to cost you about $1 billion, or I should say shareholders about $1 billion. Are these the right choices, and why did other retailers that I follow not have to make those choices, and Gap did have to do that?
Look, we entered the quarter with really strong demand across the company, as you know, and I think what we were dealt was a blow of unexpected constraint from our top sourcing country of Vietnam, with closures in about 2.5 months, and we expected 2 weeks. Now, what we chose to do was compete, right? And we had a lot of customer loyalty. Our new loyalty program had launched. We had demand that was strong. And I would much rather have a supply problem than a demand problem, Jim. And that's what we're navigating. It's true that the bulk of the issues this quarter were supply chain related, about $500 million top line affected by short stock out, and about $500 million of transitory air costs that we're incurring. But we believe the right thing to do is compete in the holiday season to have the right stock across all 4 of our brands. And that's what we're doing. So, even with the lumpiness of this quarter, when you step back and you think about the year, we are delivering near record high sales in the company's history, even with shedding $1 billion of sales, of unproductive sales through divestitures and closures. So overall on track for the strategy, disappointed in this particular quarter, but all in focus and support of our customer and competing in holiday.
I want to think forward because that's what the damage is done for our investors who are watching right now. Is it possible to still have a good holiday season in the time that's left?
Look, we chose to air our product in so that the product would be there across all 4 of our brands. And, I think that in order to compete, that is the decision we've made. We think that the outlook shows, I think a cautious Q4. That being said, our inventory supply situation is getting better and better with every week and month. And this is a big week with Black Friday and Cyber Monday, and we're ready to go and compete.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.